Hello, everyone. This is part two of a chapter one lecture. And in this session, we continue to explore how managerial economics helps managers to make better managerial decisions. And the first topic of this session is cost of a competitive return on investment funds. Okay, now in the parentheses, I put owner supplied funds. Now, a cost that is often dismissed or ignored by a decision maker is the cost of competitive returns on owner supplied investment funds. Here, owner supplied investment funds mean that a portion or a part of a total investment funds was your own money. So you take a certain amount of money from your savings account, checking account, and the rest of money was borrowed from a commercial bank. Then the money that you borrowed from a commercial bank is what? It's not your money. And you have to pay interest on the money that you borrowed from the bank. But the portion of money that came out of your bank account is your money. So you don't have to pay yourself any interest. So for the portion of money that you borrowed from a bank, you regularly cut a check to make interest payment. So it does involve actual monetary expense, cash outflow. But for the portion of money that you took out of your own bank account is your money. So you don't pay any interest. You don't cut a check to yourself. So we often ignore the cost of your money invested in your business or the cost of owner supplied funds. That's what this example is all about. So let's turn to our lecture note here. So you invested $600,000 in your restaurant business. Out of $600,000, $200,000 was taken out of your savings account, and the remaining $400,000 was an SBA, Small Business Administration loan, at an annual interest of 4%. The most profitable alternate investment opportunity yields a return of 5%. All right. Before we start, let's recall the definition of accounting cost. Accounting cost includes all monetary expenses, actual money spent. So all monetary expenses that involve actual cash outflows. That means involving actual cash outflow means you actually make payment to somebody. And there's only one exception, that is depreciation allowances. So when you purchased equipment or tools, then we assume that the market value of those tools or equipment goes down over time. That's what depreciation allowance is all about. But this is done only in accounting book. It does not really involve any actual cash outflow. That's why we say depreciation allowance is a part of accounting cost, but it does not involve any actual cash outflow. So that's why we call the depreciation allowance a non-cash expense. Now remember that depreciation allowance does not require actual cash outflow, yet it is included in accounting cost. So what's the annual accounting cost of your investment funds? So here, the money, your own money taken out of your savings account, $200,000. That's your money, so you do not pay any interest on it. So it does not involve any actual cash outflow. So it shouldn't be included in our calculation of the annual accounting cost of the investment funds. So the relevant the investment funds here is what? The money that you borrow, the SBA loan, $400,000. Okay, so $400,000, and you pay an annual interest of 4%, right? So here, so 4%. That's actually what the amount of what interest payment you have to make to the SBA. So it does involve actual cash outflow. So $400,000 times 4% is $16,000. So that is what your annual accounting cost of the investment funds. Okay. Now remember, keep in mind that you do not include portion of a fund that was taken out of your own savings account because that's your money. So you do not pay yourself any interest. So it does not involve any actual cash outflow. So that's why it won't be included in the calculation of the annual accounting cost of your investment funds. Now, next question. Then what's the economic cost, opportunity cost of the investment funds? Okay. Now, try to recall the definition of opportunity cost or economic cost. That is the opportunity cost or economic cost of your action or your choice or your option is the benefit or profit lost from your next best alternative. Okay. And here, $200,000 that you took out of your savings account. You may say, oh, I didn't borrow this money. It's my own money, so there won't be any interest accrued, the payment for the money because it's your money. So you may think, oh, it's a free money, so it doesn't incur any cost. But as a decision maker, that is wrong. Obviously here, when you decide to use $200,000 for your own restaurant business, then you are foregoing another money-making opportunity. That is, as we saw earlier, the most profitable alternate investment opportunity is what? Earning 5% return. For example, had you not invested $200,000 of your money in this restaurant business, then what? Actually, you could have invested $200,000 elsewhere and earned what? 5% return. So you have two different sources of what? Investment funds. $200,000, that's your money, and $400,000, that is what? The SBA loan. Okay, so we're gonna calculate it both costs. Okay, first. So first, we already calculated this for $400,000. For $400,000, that is the SBA loan. Okay, so you have to pay interest. So $400,000 times 4% a year. So that is what? Your annual interest payment is $16,000. Now we call this what? Explicit cost, because you actually what? Cut a check and make an explicit payment. So this is explicit cost because it does involve actual cash outflow. So this is what? Actual cash outflow. Now, what about your own money? For $200,000, that's your own money. So your money, or you may say this is your owner supplied funds. So this is where common mistakes occur because it's your own money. You don't pay yourself interest, so you think it doesn't incur any cost. That is wrong. From a decision maker's viewpoint, you have to think about the profit or benefit you forego by injecting $200,000 into your own business. Had you not injected the $200,000 in this business, then what? You would have invested the same amount of money elsewhere and earned 5% return. So that is 5% return, and that is $10,000. Okay, so now here, this is not real monetary expense. It does not involve any actual cash outflow. But this is considered the cost because this is the benefit or profit you forego by injecting $200,000 into your own business. You could have invested the $200,000 elsewhere and earned 5% return, but you did not. Instead, you injected $200,000 into your own restaurant business store. This is the benefit that you forego. Okay, so from an economist viewpoint or a decision maker's viewpoint, the true cost of what? Total investment funds. $400,000, that's an SBA loan. You make an annual interest payment of $16,000. So explicitly, you make a payment. Now, for $200,000 of your money, it does not involve any actual cash outflow, but you are giving up another money-making opportunity, another opportunity to earn 5% return on $200,000. That is what? Annually, $10,000. So true cost of what? The opportunity cost of your investment funds is what? $16,000 plus $10,000. That is what? Foregone the benefit or profit or earning. So together total is what? $26,000. So that is the what? Opportunity cost of your investment fund. Now again, as I said earlier, $16,000, that's what? The interest payment you made to the SBA. So it does involve actual cash outflow. So you say this is what? Explicit opportunity cost. And then now this $10,000. Well, you don't really make a $10,000 interest payment. It's your money. But we consider this cost because this is how much earning you give up when you inject $200,000 into your own business. So it does not involve any actual cash outflow, right? So we call this what? Implicit opportunity cost. We call that implicit opportunity cost because it does not involve actual cash outflow. So your total opportunity cost is what? $26,000. That is an explicit opportunity cost of $16,000 and an implicit opportunity cost of $10,000. Okay, so very common mistake decision makers make is what they often ignore, overlook foregone benefit or profit of what their own the investment funds. Owners supply the funds. That's the lesson we learned from this example. Okay, so here now you may say, well, accounting the definition of accounting cost is what? All monetary expense that involve cash outflows plus depreciation cost. The word depreciation here. Well, in this example, we did not mention any equipment purchased or any tools purchased. So that's why in this example, the depreciation is not included here. Our next topic is the cost of owner's time. Well, this is another cost that is often mistakenly overlooked by a decision maker. When you hire somebody, now you pay the person annual salary or weekly salary or wage or monthly salary. But when you use your own expertise, knowledge, experience, or time for your own business, well, this is after all your business. The profit you make out of your business is your money. So sometimes you don't pay yourself. In other words, you do not put yourself on the payroll. So that's why sometimes the business owners mistakenly ignore the cost of what? Their time. So that's the lesson we learned from the second example of this session. You own a business and pay yourself an annual salary over $80,000. So in this case, actually what? The owner placed himself on the payroll. So this is your business. You are the owner, and you pay yourself an annual salary over $80,000. You could work for an IT company and earn an annual salary of $100,000 had you not started the current business. So, what's the opportunity cost of your time in the current business? So, again, recall the definition of the opportunity cost. That is what? Your benefit or profit lost from your next best alternative. That's a definition of opportunity cost or the economic cost. So in this example, what money-making opportunity are you giving up to run your own business? Well, if you had not started your own business, then what? You could work for an IT company and earn an annual salary of $100,000. So that is what? The money-making opportunity you forego to run your own business. Okay. So what's the opportunity cost of your time in the current business? It's as simple as what? This. So what money-making opportunity do you give up here? So that means here in this example, it's a very simple example. You are given only one alternative. If you do not run your business, then you can work for an IT company and earn $100,000. So that is what? A money-making opportunity. What? $100,000 money-making opportunity. So that is what? That is benefit or salary you forego to run your business. So that is what exactly the opportunity cost of running your own business, your time. Okay. But let's analyze this a little more. But here, your opportunity cost of what? The cost to you of what? The running your own business is $100,000 because to run your business, you give up the money making opportunity here. But you are already placed on what? The payroll. So actually, you are getting paid $80,000 a year. Okay. So again, so out of this total opportunity cost here, if we analyze further, then what? Actually, you are paid $80,000 a year. Okay. So because in accounting book, actually you pay yourself. You cut a check for yourself, an $80,000 check. So again, because it doesn't involve actual cash outflow, so we call this what? Explicit opportunity cost. But the difference here, $20,000, $80,000 that you pay yourself is less than the salary you could have gotten by working for an IT company, right? So the difference is what? $20,000. Okay. But even though you are on the payroll, but you are not paying yourself the $100,000, you only pay yourself $80,000. So implicitly, what? It does cost you $20,000 because you get paid right now $20,000 less than other salary you could have commanded. So it does not involve actual cash outflow. So what we call this what? Implicit opportunity cost. So your the total opportunity cost of what? Your time invested in your business is $100,000. So if you further discuss this $100,000, then what? $80,000. Actually, you get paid that much because you are on the payroll. So we call that, because it does involve actual cash outflow, we call this explicit opportunity cost. But the difference, $20,000, where you don't get paid, and it does not involve actual cash outflow. So we call that difference what? $20,000 implicit opportunity cost. Okay. All right. Now, second example. What if you pay yourself $110,000? So this is an interesting example. Actually, your next best alternative is what? Making $100,000 by working for an IT company. But you put yourself on the payroll, and actually you pay yourself more than the other salary that you forego. So in this case, then what is the opportunity cost? So again, just go back to the definition of opportunity cost or economic cost. What is it? That is the profit or benefit lost or you forego from the what your next best alternative. Here you are given just in this scenario, you are given just one alternative, that is working for an IT company and making $100,000 a year. So that's exactly what the benefit or salary lost from your next best alternative. So the answer is exactly the same. So opportunity cost is again. So opportunity cost, or you may say economic cost of your time is exactly the same, $100,000. But if you analyze this a little bit, then what? You will see the difference between the first example and second example. Well, here you put yourself on the payroll and you get paid $110,000. Okay. So you pay yourself $110,000, and that is now what? $100,000. That is exactly the same as what? Your the opportunity cost. Okay. because you pay yourself what? Exactly as much as the salary that you could have commanded. So this is what? Just explicit opportunity cost that you actually pay. And then here's another $10,000 here. So then what is this? Actually, you get paid $10,000 more than your next best money-making opportunity. So then how do we interpret this $10,000? In this case, now we're going to consider this $10,000 as what? Consider this as payment to yourself. Payment to you of some competitive. Okay. So this means you believe you pay yourself $110,000, even though you're the best money that you can possibly make in your next best alternative is only $100,000. So that means what? Well, in this case, the difference $10,000 will be considered as what? Competitive return. Well, I'm doing a lot better in my business than working for an IT company. So we consider this as a competitive return to you, uh, the on the what funds you invested. Okay, so still the opportunity cost of your time invested in this business is what? No matter how much you pay yourself on the payroll, it doesn't matter. The answer is exactly the same, $100,000. That is what? The benefit or profit or salary you forego, uh, you lose from your next best alternative. Okay. All right. Our next example. Now, marginal analysis. Probably this is the most important topic in chapter one. Okay, we're going to use this, the lesson we learned today from marginal analysis again and again throughout the whole semester. Okay. First, marginal analysis is the cornerstone of managerial economics, especially for various how much decision makings. Well, there are two types of decision makings. The one is what we call how much decisions, and the other is yes or no decisions. Or this is sometimes called a dichotomous decisions. So let me give you some examples. When you run a business as manager, you face a lot of questions like this. Should we increase the price of a product, or should we reduce the price of a product? The answer is what? Okay, if we're going to increase the product price, then how much? By how much should we raise the product price? Or if we needed to reduce the product price, then by how much should we lower the product price? Or if you're going to hire few more workers, then how many more workers do you need to hire? Or if you needed to lay off some of the workers, then how many workers do you need to let go? So it's not about yes or no. You are not changing your course of action. You still do your business, but you adjust the level of your activity, business activity. So this kind of decisions are called how much decisions. Of course, there are there is a different type of decision making. That is a yes or no decision. This means what? You decide whether you continue your current activity or stop doing it. For example, should we stay in business? Answer is either yes or no. Stay in business or quit your business and do something else. Or should we introduce this new product in market? The answer is just a yes or no. Either you start selling your new product in the market or you just what? Discard the plan to introduce a new product. Even after you what? Spent a lot of time and money to develop a new product, in the last minute you may decide not to introduce the product in the marketplace. So that is what? Yes or no decision. So marginal analysis does play a very important role in all of what? How much decisions. And that's the lesson that we're gonna go over in this session. Okay. So another good example of how much a decision is what? Suppose you are running a business firm and you manufacture certain product. You have a multiple plants, factories. Then you have to decide. Of course, you have to decide how much of the product you're going to produce. And then since you have what? More than one manufacturing facility, so you have to decide where to produce how much of your product. That's also what? An example of how much decision. So whenever managers are facing how much decisions, this marginal analysis is what? A primary guiding principle in their decision making. Okay, so you may still remember one of the 10 principles of economics you learned in the principles of economics, either Econ 201 or Econ 202. One of the 10 principles of economics is what? Rational people think at the margin. I don't know whether you still remember that lesson, but let me write here. Rational people think at the margin. So here, in economics, when we say people are rational or decision makers are rational, what we mean by that is people are acting or behaving in a manner consistent with their goal. They are not self-defeating or they are not defeating the purpose. So when you do something that is what? In line with your ultimate goal, then what? You are said to be rational. Then what do we mean by at the margin here? First, the margin means what? Small incremental adjustment made to your existing plan. So when you think at the margin, what it means is what? You adjust the level of your business activity a little bit. And then from that small adjustment, you compare additional benefit and additional cost. So as long as additional benefits are greater than additional cost, then what? You increase the level of the activity. For example, you decided to offer a price discount. So what's the additional benefit of offering price discount, and what's the additional cost of reducing offering a price discount? Well, additional benefit is first because you reduce the product price, you expect to sell more units because your product gets cheaper. So additional benefit here is what? Okay, as a result of a price discount, you expect to sell more units. So compared to the previous price, what's the additional revenue you receive compared to your previous revenue when there was no price discount, okay? After price discount, how much additional revenue do you get? That's an additional benefit. Now, additional cost is what? Because you are selling more units. You are selling more units as a result of a price discount. Now you have to produce and sell more units. It does involve additional production of the product. So compared to previous situation when you did not offer any price discount, now with the price discount, you sell more, you produce and sell more. So what is the additional production cost, for example? So you compare additional revenue you receive, that's additional benefit. Now, additional cost of a production because you sell more units. So you compare these two. So as long as additional benefit, extra revenue you receive is greater than extra cost, additional cost, then what? Your action is justified, and then what? Your price discount will be successful. That's an example of what? Rational people thinking at the margin. So here, we're going to use a couple of examples to have a better understanding of what the marginal analysis. The first example, the table below shows the total benefits and total cost of extracting crude oil, petroleum, in increments of 1 million barrels. Find out the optimal or profit maximizing amount of oil to extract. So this is an example of how much decision. We are not deciding whether or not to extract oil here. You will stay on the same course, same path. So you are doing this business, and now you are deciding whether you should extract more oil, a little less oil. So this is an example of how much decision. That's why marginal analysis is crucial to an example like this. So the first column shows total amount of crude oil you extract. So when you extract no crude oil at all, then what? No benefits because you are not selling any oil. Of course, zero cost because you are not extracting any crude oil. Okay. Now, when you extract 1 million barrels, then now you can sell 1 million barrels of oil in the marketplace. So your revenue is $80 million. Let's assume that to extract 1 million barrels of oil, you had to incur a total cost of $20 million. So here, let's compare total benefits and total cost. Or in this case, actually, you can sell the oil. So what? Instead of a total benefit, you may call this what? Total revenue. Okay, either way. So here, when you produce no oil, so what? The total benefit, net total gain is what? The difference between total benefit, total revenue, and total cost. So what? Difference is zero here. Now, when you extract 1 million barrels of oil, your benefit, sales revenue is $80 million, cost is $20 million. So what? So the difference is 80 million minus 20 million. So $60 million. Okay. Now, what if you produce 2 million barrels of oil, let's say a day or a week? Then, well, here we assume the total benefits or sales revenue of selling 2 million barrels of oil is what? $150 million. So net gain is the difference is $150 million minus now as you extract more oil, so you may have to go a little deeper. So that's why we assume the total cost of rising a little faster. So here $50 million. So here the difference is $100 million. So obviously, how much oil are you going to extract? Well, if you extract only 1 million barrels of oil, your net gain is just $60 million. That means what? Revenue after adjusted for cost. So your profit is just $60 million. But if you extract the 2 million barrels of oil, then what? You enjoy bigger profit. The difference between total benefit and total cost is even greater, $100 million. Now, what if you extract 3 million barrels of oil a day or a week? Then now the difference is $210 million minus $90 million is now it's $120 million. The profit is even greater. So definitely so far, you are better off extracting more oil. Now, what if you extract 4 million barrels of oil? Then the difference between total benefits and total cost is what? It's the same as the previous case, so still $120 million. And now, if you extract 5 million barrels of oil, then what? When you sell 5 million barrels of oil in the marketplace, then what? Probably as you sell more and more oil price may go down. So that's why total benefit is increasing, but what? The additional revenue you get here is what? The total revenue increases from 260 to 300, so what? The difference is only $40 million, okay? Anyway, so here total benefit minus total cost is 300 million minus 200 million, so it is $100 million. So here, it is obvious. If you extract 5 million barrels of oil a week or a day, then what? Actually, your profit is smaller than when you extract 4 million barrels of oil. Okay. So probably what? Here, if you are the manager, probably what? You will end up either extracting 3 million barrels of oil or 4 million barrels of oil because you get the same amount of profit here. So what's implicitly assumed in this table is what? As you extract more and more oil, then what? You have to go deeper and deeper, so total cost is increasing faster. Okay. For example, when you extracted 1 million barrels of oil, total cost was $20 million. But when you extract 2 million barrels of oil, total cost is what? More than doubled. Instead of $40 million, total cost is $50 million. So as you extract more oil, cost is increasing. Now look at the second column, total benefits. Well, when you sold 1 million barrels of oil, your total benefit or revenue was $80 million. But when you sold 2 million barrels of oil, total benefit or total revenue is less than doubled. It's not $160 million. Instead, it is what? $150 million. So what you assumed here is what? As you extract and sell more and more oil, then what? Per barrel price may be going down. So your total benefit increases, but increases less than the what? The proportion to the what? In less than the in less proportional to the what? Total amount of oil you extract. Okay, so that's what's implicitly assumed. So here, in the first table, everything was given in terms of a total sales revenue and total cost. So you just subtract the total cost from total benefit. You can easily figure out the profit maximizing quantity. In this case, either 3 million barrels of oil or 4 million barrels of oil. Either way, you end up making the largest profit, which is $120 million. So now we're gonna figure out marginal benefit and marginal cost from table 1. So using the figures in the table above, complete the table below that depicts marginal benefits or marginal revenue, marginal cost, and the net marginal gains. Okay, so here, first briefly define the what marginal benefit or marginal revenue here. Okay, so marginal benefit. Now, in the context of this example, we may call it the what marginal revenue, additional sales revenue. So try to recall what you learned in the principles of microeconomics, ECON 202. So that is one. So change in total revenue over change in quantity as a result of selling or extracting more oil. So change in quantity and then change in total revenue, how much additional revenue you get. So that's a marginal benefit. Likewise, marginal cost is simply the value of the ratio of this. As you extract more oil, to extract more oil, you're going to have to spend more money. So you're going to have to incur additional cost, the change in total cost. So what's the change in total cost as a result of extracting additional oil? That is a marginal cost. So here we're going to go back and let me change the color of the pen a little bit here. Okay, so here. Now, when you first time increase the production from 0 million barrels to 1 million barrels. So here, what is the change in Q? Change in Q is what? 1 million barrels. Okay, so it's simply the difference between 0 and 1 million barrels is 1 million barrels. And then, what is the difference between the total benefits when you produce no oil and when you produce and sell 80 million barrels of oil? So the difference is what? The difference is 80 million. Okay, so now look at this time. When you produce the even more oil, from 1 million to 2 million barrels of oil, the difference here what? So change in Q is exactly what? 1 million barrels of oil. Okay, and then now, so when you sell 2 million barrels of oil, now compare it when you sold 1 million barrels of oil, how much extra additional revenue do you get? So here, additional revenue is what? As you sell the additional 1 million barrels of oil, total benefit increases from 80 to 150 million. So additional revenue benefit you get here is what? $70 million, the difference. Okay, and here, now what if you increase the production from 2 million to 3 million barrels of oil? Then again, here, change in Q is still 1 million barrels of oil. As a result, how much extra revenue do you get? When you sold 150 million barrels of oil, 2 million barrels of oil, total benefit was $150 million. But when you sell 3 million barrels of oil, total benefits now $210 million. So the difference is additional revenue as a result of what? Selling another 1 million barrels of oil is what? $60 million. Okay. And so you just continue here. So again, you increase the production of oil by 1 million barrels at a time in increments of 1 million barrels. Then now sales revenue increases, total benefit increases from 210 to 260. So additional revenue you get here is $50 million. And finally, if you increase the production from 4 million barrels to 5 million barrels, then what? Again, the changes in output is 1 million barrels of oil, and the extra revenue you get here is what? $40 million here. So we just applied here what? The definition of a marginal benefit. That is a change in total revenue, change in total revenue. So this is what? Change in total revenue. And this is a change in Q. So simply you plug what? Change in total revenue over change in Q, plug those values in the definition, then what? So when you produce first 1 million barrels of oil, the marginal benefit, that is what? Or marginal revenue is again change in total revenue over change in Q. So, well, of course, when you produce no oil at all, then what? There's no change in revenue whatsoever. So we can just leave this first row blank, okay? But then when you start extracting and selling oil, then additional benefit or additional revenue you get is what? 80, 70, 60, 50, and 40. So we can copy those numbers right here. So 80 million, so that's what? When you increase your production from 0 output to 1 million barrels, extra additional revenue you get is what? $80 million. And then $70 million, $60 million, and $50 million. And finally, on the next table, it is what? $40 million. Now, let's calculate marginal cost here. Exactly the same way. So when you increase the production or extraction of oil by 1 million barrels each time, total cost is increasing what? First here, change in total cost is what? $20 million. And then when you extract another 1 million barrels of oil, then what? Total cost increases from 20 million to 50 million. So the difference is $30 million. So likewise here, whenever you extract another million barrels of oil, the cost is increasing because, as we assumed, you have to go further down, deeper and deeper to extract more oil. All right. So that's exactly what the definition of a marginal cost: the change in total cost over change in quantity. Okay. So we're gonna copy that numbers in this table. So that was, so again, when you produce no output, there's no change. So what the first row is left blank, and then $20 million, $30 million, $40 million, and $50 million. And the last one was $60 million. So we're gonna put it here. So $60 million. Okay. So let's go back to the principle. Rational people thinking at the margin. That's the essence of the marginal analysis. You increase or you make adjustment to your activity. Until when? Until additional revenue is what? As long as additional revenue you receive is greater than additional cost, then what? You continue to increase your activity, level of activity. But once additional benefit you receive is the same as additional cost, then what? That's when you stop. Okay. And if additional benefit is smaller than additional cost, then what? You have gone too far, or you are either overproducing or overselling. Okay. So now compare marginal benefit, marginal revenue, and marginal cost, additional benefit and additional cost. So here, additional benefits far greater than additional cost. So yes, producing 1 million barrels of oil is well justified because here, additional benefit is what? Additional revenue is just 80 million. Additional cost is only 20 million. Additional revenue is what? Far greater than additional cost, the marginal cost. So the difference is now what? 80 million minus 20 million is $60 million. Okay. So don't pay too much attention to the net marginal gain, because here, as long as what additional money you receive is greater than additional cost, then what? It is justified. What about another million barrels of oil? So should you produce a total of 2 million barrels of oil? Yes, you can increase your production from 1 million barrels to 2 million barrels. Why? When you produce another million barrels of oil, extra revenue you get is 70 million, but extra cost is only 30 million. So additional benefits are greater than additional cost. It is well justified. Okay. In other words, the second 1 million barrels of oil gives you $70 million of revenue, but it costs only what? Additional cost is only 30 million. So your net marginal gain is 40 million here. Now, should you increase your production to 3 million barrels? Yes, again here, because additional revenue, additional benefit, additional revenue, additional benefit you get from a third 1 million barrels of. The last 1 million barrels of oil is 60 million, but additional cost of extracting the last 1 million barrels of oil here is only 40 million. So my additional benefits are greater than additional cost. So additional benefit is what? $20 million more than additional cost. So it is well justified. Now, should you increase production again? Increase the production from 3 million barrels to 4 million barrels a week? Well, this is now what? See, here you are indifferent, because when you produce 4 million barrels of oil, then additional benefit from the last 1 million barrels, number 4, 1 million barrels, okay? The last 1 million barrels of oil is what? $50 million. Additional cost is also exactly the same as what? $50 million. So here, so the difference between additional revenue and additional cost becomes 0. Now, what about 5 million barrels oil a week? Now, this time, if you produce 5 million barrels of oil a week, then what? The last 1 million barrels of oil, the number 5, 1 million barrels of oil, additional benefit you get is only 40 million. But the last 1 million barrels of oil actually cost you $60 million. So additional cost is now greater than additional benefit. So what? Here, your net marginal gain is what? On that last 1 million barrels of oil here, what is your net gain? You receive $40 million more, but you have to spend $60 million more. So your net gain is what? A negative number. So there's absolutely no reason to produce what? As many as what? 5 million barrels of oil. So according to the rational people thinking at the margin principle, then what? You adjust the level of activity by comparing additional benefit and additional cost. In this context, additional revenue and additional cost. So you continue to increase the level of activity until when? Additional benefit is the same as additional cost. That's what the essence of what? Marginal analysis. Okay. So here, so when you produce 4 million barrels of oil, that's when what? Additional benefit is the same as additional cost. And that's exactly when you're going to end up making the largest profit here, $120 million. And here you may say, well, if you stop at the 3 million barrels of oil a week, still you end up making the same amount of profit. But in this case, what we increase the what oil production by 1 million barrels at a time. But if we make a much smaller adjustment than what, then you can confirm that your profit is what maximized when your additional benefit is the same as an additional cost. In this example, 4 million barrels. Okay. So this example actually what shows us how marginal analysis works. Okay. So whenever you try to choose the right level of a business activity, what you need to do is what? Calculate additional benefit, in this context, additional revenue, and calculate additional cost and compare them. So as long as additional benefits are greater than additional cost, you keep increasing the level of activity. And then when should you stop? You stop where? When marginal benefit, additional benefit is exactly the same as additional cost. That's the lesson. Okay. So here, don't ever think, oh, here, for example, 4 million barrels of oil here. When you read the table like this, okay, marginal benefit of 4 million barrels of oil is $50 million. It doesn't mean that you are getting additional benefit of $50 million by selling 4 million barrels of oil. What it means is what? When you produce 4 million barrels of oil, then what? Compared to your previous production level, 3 million barrels. So the additional 1 million barrels of oil gives you $50 million additional benefit. Or you can say, when you produce 4 million barrels of oil, then what? Each time we increase the what? Production by 1 million barrels of oil, right? So when you produce 4 million barrels of oil, your additional benefit from the last 1 million barrels of oil is $50 million. Or here, if you compare this to then what? How do we interpret this number, $60 million? What it means is what? When you increase the output from 2 million barrels of oil to 3 million barrels of oil, then what? The last 1 million barrels of oil, additional output gives you additional benefit of what? $60 million. That's what it is. So whenever you are given totals, then by calculating change in output, change in revenue, change in cost, total cost, what? You given totals, then what? You should be able to complete what? A table of what? Marginal benefit and marginal cost. And the lesson we learn from here is what? You can always choose the optimal level of your business activity by comparing additional benefit and additional cost. Okay. All right. So I believe we have so here the same information is presented here in a simple graph. The blue line is showing what? Your additional revenue, how additional revenue changes as you keep producing more and more oil. And then the orange line shows the additional cost. Each time when you increase the output production by 1 million barrels, then how each of those additional 1 million barrels of oil cost you. So as we saw here in the table, then what? As you continue to increase the oil extraction by 1 million barrels each time, then what? Last 1 million barrels, the cost of extracting last 1 million barrels of oil is increasing what? From 20 million to 30 million to 40 million to 50 million, $60 million. That's what it is. And then what? additional revenue, additional benefit is exactly the same as additional cost. Two lines cross each other right here, and that happens exactly when you produce 4 million barrels of oil. Okay, all right. So simply put, whenever you pick the output level where marginal benefit here, so marginal benefit or marginal revenue is the same as a marginal cost. So here, marginal revenue is exactly the same as marginal cost. Then what? That's the optimal output level or profit maximizing output level. Okay. All right. Now, another example. The table below shows the total benefits and total cost for various levels of output. Complete the columns of a marginal benefit and marginal cost. So here, again, marginal benefit is what? Change in total benefit over change in Q, level of activity. And the marginal cost is what? Change in total cost over change in level of activity. So here, total quantity is now what? It's a very small number. Each time, total output is increasing by 1 each time. Okay. And whenever you increase the output by 1 each time, total benefit increases what? From 0 to 50, 50 to 90, 90 to 120, 120 to 140. Okay. And total cost increased from 0 to 5, 5 to 10, 10 to 18, 18 to 30. So here, so always the difference is what? Here, change in Q is always equal to 1. Each time it increases by 1. Now here we're going to measure marginal benefits. So change in total benefit over change in Q, change in total cost over change in Q. So here, what's the change in total benefit? 50. Change in total benefit is 40. Change in total benefit here is 30 and 20. So here, change in total cost is what? From 0 to 5, so 5. And then next is, again, 5, and then 8, and then 12. So these are what? Change in total benefit and change in total cost, right? So change in total benefit divided by change in Q. Change in Q is always what? Equal to 1 in this example. So when you do marginal analysis at the zero output level, marginal is not defined because there's no output. So here, so 50 divided by 1 is what? 50. 40 divided by 1 is 40. 30 divided by 1 is 30. 20 divided by 1 is 20. Now cost, total cost increased by 5 first time. When you increase the output by 1, so it's a 5. Again, it's a 5. And then 8, then 12, and 12. So according to our marginal analysis, then what? You continue to increase the output level of activity as long as what? Marginal benefits greater than marginal cost. So here, yes, greater. So do more. Still, marginal benefits greater than marginal cost. Do more. Still, do more. Do more. Okay. And now this table is what? Actually, we can further extend this this table then probably further down there somewhere, probably what? We will find the output level where marginal benefit is the same as marginal cost. And then that's exactly what? Profit maximizing level of output. Okay. All right. So this will conclude our the part 2 lecture, part 2 of a chapter 1 lecture. And this will be the all for this session. And So if you have any question, please don't hesitate to contact me through email. Um, and so I'm gonna have another session next time with a new chapter. Thank you so much.